You're seeing that the possibility of rate cuts is pretty strong, that you think some rate cuts are coming up. We had a strong GDP report, all bullish signs for the economy. But right now, you're saying it's time to hedge. So give us a sense. What's your Wex word today?
Well, it's a form of life insurance policy, Frank. We all don't like to think about it. Hopefully we never have to use it, but one day we will. So I think it's a good time, the best time actually, to put on those protective hedges, such as protective options on the technology sector, which is one of my tactical recommendations. Now, the best time to do so is when markets are strong. So you don't want to be looking at this protective options when you're in a free fall.
What do you make of some of the action that we've seen, the so-called rotation? Again, small caps having a run right now. Also, other areas of the market like biotech outperforming the broader market.
Yeah, I think a lot of electoral risks are being priced in. The Trump trade, I think, is probably part of that. You know, the Trump trade favors the small cap value stocks, and I think there's probably some legs to that. What I'm recommending is to consider the counter argument, which is that the craziness that we've seen in the markets and this Teflon reaction in the S&P 500, which just continues to move higher, maybe doesn't have too much longer to last, and this upward trajectory could see some downside. We've seen consumer sentiment and consumer spending roll over a bit, and we're also seeing some weakness in the labor market. Therefore, I like putting on those defensive sectors such as utilities, such as the puts options, and such as steepeners.
All right. PCE coming up later today. What are your expectations? What do you think the market impact will be?
Our in-house forecast models, Frank, put us at 0.2% month on month, which is in line with consensus expectations. I do think today is probably going to be another risk-on day because the market is discounting, I think correctly so, the first rate cut in September. Everyone's talking about the SOM rule. I think that that's probably going to trigger in the next couple of months. It doesn't necessitate that we're in recession at the moment, but it is another warning signal on the horizon and another reason I think we need to be positioned defensively at the current moment.
Okay, you have a pick for us today, but your pick is actually an area that you say you should stay away from. That's chips. I'm looking at the SMH below its 50-day moving average, kind of going through its 100-day moving average. Why are you down on chips right now?
Well, I think under either electoral outcome, but especially the Trump outcome, we're going to have more protectionist policies with regard to China. And I think that there are some risks on the horizon there. Industrial policy, in my view, is kind of a euphemism for protectionism. And I think that we need to be positioned accordingly. So that is a risk that's coming up in the next 3 to 6 months. And I think, again, that it's important to consider the underappreciated, underpriced risks in the market now.
So if you're not bullish on chips, you have some questions about chips. Does that mean you have some questions about the AI trade? Because they seem very closely linked.
Sure. The AI trade has certainly run long, and the tooth valuations are extended across the board, both in AI and in the broader S&P. And I think that you're probably going to see a little bit of a correction over the course of the next 3 to 6 months, which is reason additional for that protection.